Okay, I believe that we'll wait just one more second to allow everybody to join that's wanting to join us today. Okay, we'll go ahead and get started. Thank you for attending. This is our fourth monthly webinar series that we've had. So thank you for attending the April version, which is titled "What's New with Social Security." 8 topics to watch in 2026. Um, my name is Les Stewart, and I'm an advisor and co-owner here at Southeast Retirement Planners here in Hickory, North Carolina. So for those of you joining us, once again, thanks, and we'll get started. Learn a little bit about what Social Security has to offer this year for you guys. Before we get started, though, want to always have a reminder that there are 5 keys areas of financial planning: preservation planning, retirement planning, tax planning, estate planning, and investment planning. And if you're getting comprehensive financial advice from a company, it should encompass all 5 of those uh, pieces of information and be revisited often. Um, Also want to make note to visit our website often. We try to update that with new useful information. That is scretirementplanners.com, and you'll see that there's ways to get up to date on resources that have been provided, sometimes by us, sometimes by a third party. Um, Also, you can learn about us if you've got a friend or family that would like to learn more about who we are and how we work. It's a good place to start. So check that out. And you can also find some of our past recordings of our webinars and things like that. And finally, how we work with clients. If you're not a client of ours, we try to be the hub of your financial professionals. We don't do attorney work. We don't, do taxes for you, but we can be a good resource to help you get a better result with those professionals and make their life a little easier too. So, as you can see, we like to work with your attorney, accountant, um, Social Security professional, which we'll talk a little bit about that today, and then long-term care, which is something that more and more of us are facing. We are a good resource to help point you in the right direction and get you prepared for that situation as well. So let's get started on our topic. What's new in 2026? Here's some of the topics we'll be touching on. Social Security once again paid a cost of living adjustment this year. We'll talk about how the cost of living adjustment, or COLA, as the shortened, is determined. But put it into context, you see what it means for you uh, with Social Security benefits going forward. Another number affected by the cost of living adjustment is the earnings test threshold. We'll talk about how much you can earn in 2026 without having benefits withheld if you claim Social Security before full retirement. Next, we'll talk about taxes, both Social Security payroll taxes and income taxes you may have to pay on your Social Security benefits. And for those of you on Medicare, we'll go over the new Part B premiums for 2026 and see why it's not such a straightforward number anymore. We'll also cover dates to watch in 2026. We'll give you an update on the status of Social Security trust funds and discuss some ideas for reforming the system to make it solvent for the future. And we'll give you an update on Social Security claiming strategies. And finally, we'll talk about the repeal of the windfall elimination provision and government pension offset. These provisions affected people who worked in jobs that didn't pay into Social Security, such as government workers and some teachers. So let's get started with the cost of living adjustment. In October of every year, the Social Security Administration announces a bunch of numbers that are determined by the rate of inflation over the prior 12 months. The most eagerly awaited number is the cost of living adjustment, or the amount by which Social Security checks will be raised. Another number is the new earnings test threshold. And finally, the maximum amount of earnings on which Social Security taxes are assessed. The cost of living adjustment for 2026 is 2.8%. This means if your current benefit is $800, you'll be getting an extra $22 a month. The higher your benefit is, the higher your COLA or cost of living adjustment is. If your benefit is $4,000, which could happen if you're a maximum earner and you claimed your benefit at age 70, you'll be getting a cost of living adjustment of $112 per month. The annual COLA has varied over the years, averaging about 2.5%. The Social Security trustees project a 2.4% COLA going forward. The COLA is based on the Consumer Price Index for all the urban wage earners. The Consumer Price Index measures the change in a basket of goods and services that a typical urban worker might buy. It covers food, transportation, housing, entertainment, healthcare, and pretty much everything people spend money on. In any case, the COLA is announced each year in October and takes effect with the Social Security checks you receive in January. Even if you haven't started your Social Security yet, let's say you're delaying it to age 70 to get a higher amount, your benefit will be raised by the cost of living adjustment. So when you do claim your benefit, you can be sure it will reflect each year's COLA. If you're interested in learning how the COLA was calculated, you can visit the website, which is shown here, which is the ssa.gov/ that's located here below. Okay, so that's the first big number change. Next, we'll be discussing the earnings test. The earnings test threshold is affected by the cost of living adjustment. As you probably know, if you're under full retirement age and you work and receive Social Security benefits, part of your benefit may be withheld. They withhold $1 for every $2 you earn over the threshold, which went up to $24,480 this year, compared to $23,400 last year. If you earn less than $24,480, none of your benefits will be withheld. But I would just like to comment that trying to earn less money is not exactly a formula for wealth building. If you're under full retirement age and have the opportunity and ability to work, it's probably better to earn as much as you can and to delay applying for Social Security. The new threshold for the year you turn full retirement age is $65,160, up from $62,160 last year. This higher threshold comes into play if you were receiving Social Security last year and you turn full retirement age in 2026. In the months leading up to your full retirement age month, $1 in benefits will be withheld for every $3 you earn over $65,160. Once you turn full retirement age, no benefits will be withheld no matter how much you earn. While we're on the earnings test, I'd like to take a moment to explain the monthly earnings test. This comes into play the first year you apply for Social Security benefits. So let's say you're under full retirement age. You file for Social Security this year and you continue to work. If you earn more than $2,040 in any month, your benefit will be withheld. Then next year, you'll be subject to the regular annual earnings test, the $24,480 adjusted for next year's cost of living adjustment. Generally, our recommendation is to wait until you stop working to apply for Social Security, so you don't have to deal with the earnings test. But there may be exceptions, and we can certainly discuss your individual circumstances. Okay, Having said all of that about the cost of living adjustment and the earnings test, I'd like to take a moment to discuss payroll taxes. The maximum earnings subject to Social Security tax went up to $184,500 from $176,100 last year. This means higher earners will pay Social Security taxes on more of their earnings. But remember, the Social Security tax represents a pretty good investment in the form of inflation adjusted income that lasts for life. The more earnings you have and the more Social Security taxes you pay, the higher your benefit will be. And remember, as long as you are working and paying into Social Security, your benefit will continue to be adjusted. If you approve your earnings record, your benefit may go up, even if you've already started collecting. If you're interested in seeing how the Social Security Administration calculates the earnings cap, you can follow this link or type this link into your browser at ssa.gov. The Social Security tax rate did not change. As an employee, you'll still pay 6.2% in payroll taxes on your earnings. Your employer will pay the same amount. If you're self-employed, you will pay both parts for a total of 12.4%. The Medicare tax also did not change. The employee's portion is 1.45% on all earnings. Self-employed people pay both sides, or 2.9%. Here's the math. If you earn a maximum of $184,500 in 2026, you'll pay $11,439 in Social Security taxes. If you're self-employed, you'll pay both the employees and the employer's share of the tax, which adds up to $22,878. The Medicare tax will be on top of that. That takes care of payroll taxes, or the taxes collected to fund Social Security and Medicare. Now we're going to talk about the taxes on your actual benefit, which are a little bit different. Ever since 1984, Social Security benefits have been subject to some level of taxation, depending on your other income. This table shows the taxation of Social Security benefits based on the various income levels. Income in this case means provisional income, which includes adjusted gross income plus 1/2 of the Social Security benefit plus any tax exempt interest. If provisional income is under $32,000 for a married couple, no benefits are subject to tax. If provisional income is between $32,000 and $44,000, up to 50% of a married couple's benefits are subject to tax. If provisional income is over $44,000, up to 85% of the benefits are subject to tax. The thresholds for a single individual are $25,000, $34,000, and $34,000. In the case of married filing separately and living with spouse, 85% of Social Security is taxable regardless of income level. Note that these income thresholds were never adjusted for inflation, so more and more people are having to pay income tax on their Social Security benefits. The important thing to remember here is that up to 85% of your Social Security benefits may be subject to tax, depending on how much other income you have. The law recently changed with regard to RMDs, or required minimum distributions. You may remember that it used to be you had to start taking minimum distributions from your IRA starting at age 70 and a half. Then a couple of years ago, the age was raised to 72. New legislation raised it to 73 starting in 2025. Please let me know if you need help figuring out your RMDs. We work with that quite a bit. The thing about RMDs is that you may have had your income and tax situation all figured out, and then you have to start taking required minimum distributions from your IRA. If you don't plan ahead, these required minimum distributions can bump you into a higher tax bracket. In addition to having to pay the income tax on the RMDs, they might cause you to pay more taxes on your Social Security benefits. It's a good idea to plan for Social Security taxes ahead of time. Those of you who are still well in advance of your RMD age might want to start drawing down those assets so that the RMDs don't force you into a higher tax bracket for Social Security. The operative word there is might. Beating the Social Security tax might not be worth it. Pending other tax considerations, please consult with a qualified tax professional or come in and talk with us, and we'll be glad to guide you to that. You may also want to convert to a Roth IRA, which generates tax-free income. Again, please consult with the tax professional or someone that's knowledgeable about it. The other way to pay less in Social Security is to delay it, reducing the number of years your income is subject to tax. This is not the main reason to delay benefits. Delaying Social Security benefits is mostly advantageous because of the higher benefits you get by delaying it. But it also helps with the tax situation as well. Now, let's move on to Medicare premiums. The base Part B premium is now $202.90 per month. This is up from $185 last year. If the base premium is lowered, some people will pay more due to the income-related monthly adjusted amount, or IRMAA, which I'll talk about in a minute. If you're on Social Security and have your Medicare Part B premium deducted from your Social Security benefit, there's a hold harmless provision that helps your check from going down if the Social Security cost of living adjustment doesn't cover the rise in the Part B premium. This year, the Social Security COLA was 2.8%, while the Part B premium went up by nearly 10%. In most cases, the dollar amount of the COLA more than covered the increase in premiums, so the hold harmless provision does not apply. The issue that will be affecting more people is the income-related monthly adjustment amount, or IRMAA, applied to their Medicare premiums. The IRMAA is an extra premium you must pay if your modified adjusted gross income exceeds certain thresholds. In 2026, the first threshold is $109,000. If you are single or married filing separately, up from $106,000 last year. For married couples, the first threshold is $218,000, up from $212,000. Modified adjusted gross income for this purpose is adjusted gross income plus tax-exempt interest. Your premium each year is based on the tax return you filed 2 years prior. So if you were on Medicare, your 2026 premium is based on the income you reported in 2024. But if your income has changed due to a specific life-changing event such as retirement, you can appeal. In other words, if you reported high income in 2024 and you've since retired, you can appeal the higher premium. Please note that a one-time capital gain is not grounds for appeal. In other words, if your 2024 tax return shows high income because you sold an asset in that year, you may have to pay the higher income premium or the higher premium in 2026. But if your income has gone down in 2025, your 2027 premium will be lower. This table shows the Part B and Part D premiums for the different income levels. If you're single and your income is under $109,000, or if you're married and your income is under $218,000, you pay the regular Part B premium of $202.90 per month. There will be no income-related adjustment if your income falls into one of these other tiers. You'll pay an income-related adjustment on top of the base premium. For example, if you're in the second tier, you'll pay an extra $81,200 for Part B and $81.20 for Part B and $14.50 for Part D on the top of your regular premiums. Keep in mind that these are per person. So if you're a couple, you can double those amounts. Your tax return from 2 years ago is used to determine this income-related adjustment. For example, the adjustment for 2026 would be based on the income tax reported for your 2024 tax return. And keep in mind that the premiums shown here do not include premiums for drug plans, Medicare supplement plans, or Medicare Advantage plans. This is for Medicare only. Whether you're already on Medicare or getting ready to start, there are some dates you'll need to pay attention to. The Medicare Advantage disenrollment period is from January 1st to March 31st. During this time, you can get out of a Medicare Advantage plan and go back to the original Medicare. But do make sure you can get supplemental coverage if you're going back to the original Medicare. You'll want to get the gaps covered with a Medigap policy. But unless you're applying during your Medigap open enrollment period, which is generally the first 6 months after enrolling in Part B, they don't have to take you. If you have health issues and you drop your Medicare Advantage plan, you may not be able to get a Medigap policy. So be sure to get that lined up first. If you're thinking about dropping your Medicare Advantage plan, January 1st through March 31st is also the Medicare general enrollment period. This is for people who never signed up for Medicare when they turned 65 or left their employer plan. If you do sign up for Medicare during this time, your coverage will start the month after you enroll. The annual open enrollment period for people on Medicare is October 15th to December 7th. In September, you'll receive information from your current plan about their offerings for next year. Pay attention to this. Your premiums might be going up, or your coverage might change, or there might be new plans in your area. If you currently have a Medicare Advantage plan, you'll want to see how it will change for next year. If you have an original Medicare, you'll want to see how your drug plan will change for next year. Then you'll want to look at other plans offered in your area to see if any of them might be better. If so, contact the new plan by December 7th. If you do nothing, you'll be re-enrolled in your current plan for another year. Although you will have another chance to switch Medicare Advantage plans during the disenrollment period we just talked about, it's much more efficient to make your choice during this annual open enrollment period and stay in your new plan for the full calendar year. So what about the future of Social Security? We get that question all the time. Social Security was designed as a pay-as-you-go system. Payroll taxes from current workers go into a trust fund and are immediately paid to the current retirees. Because baby boomers have been in their peak earning years, the trust fund has accumulated more than needed for the current benefits. Right now, the trust fund holds about $2.7 trillion, which is invested in special issue treasury securities. As baby boomers start retiring, these trust fund assets will gradually be drawn down. Over the next 75 years, costs will begin to exceed income. There are enough reserves that the system will be able to pay 100% of the promised benefits until 2034. After that, if nothing is done to reform the system, income will be sufficient to cover just 81% of the promised benefits. Although the Social Security system is not in imminent danger, most people agree that the earlier reforms are instituted, the less painful they will be on everyone. It's really just a math problem that involves an increase in revenues, a cut in benefits, or a combination of the two. Here are just a few of the ideas that have been proposed. One is to increase the maximum earnings subject to Social Security tax. Currently, $184,500 in earnings are subject to the 6.2% tax paid by you and your employer. One way to shore up the system is to raise the earnings cap or eliminate it altogether. Another reform proposal calls for raising the full retirement age. Currently, full retirement age is 66. For people born between 1943 and 1954, and 67 for people born in 1960 or later. An argument in favor of raising the retirement age is that people are living longer. An argument against it is that people whose occupations involve hard physical labor really can't work until age 70. Still, another reform proposal would change the benefit formula so that the future increases would happen at a slower pace. This would affect the benefits of future retirees. And some are talking about changing the formula for cost of living adjustments. This could give retirees small benefit increases going forward, although the changes are expected to be minimal. Given there are a lot of ways the Social Security system can be reformed, is Congress likely to address the issue this year? Probably not. Other issues are taking priority, and because of the $2.8 trillion trust fund, benefits are not in imminent danger. The last time Congress made major changes to the Social Security system was in 1983. The trust fund was within a few months of running out of money. Theoretically, Congress has until 2034 before they have to worry about that happening. I'd like to talk a little bit about Social Security claiming strategies, even though these may not affect all of you, especially those of you who have already started taking your Social Security. Some of you may have heard about a strategy called file and suspend. Following a law change in 2015, this strategy is no longer available. The other strategy, claim now, claim more later, is also no longer available. We only mention these because people still ask about them. The rule now is that you cannot take a spousal benefit if your own benefit is higher. Although some of the spousal loopholes have closed, it's still possible for a lower earning spouse to receive 50% of the higher earning spouse's PIA if the lower earning spouse's own benefit is lower. Please note that if the lower earning spouse is claiming the spousal benefit before her full retirement age, the spousal benefit will be less than 50%. Also, the other spouse must be taking his own benefit. And if the higher earning spouse benefit includes delayed credits because he claimed after full retirement age, the spousal benefit will not include those delayed credits. We'd be glad to run a spousal planning analysis for you to show you when would be the best time for each of you to claim your respective benefit. Please see me if you're interested in this. On January 5th, 2025, the President signed into law the Social Security Fairness Act, which has passed by Congress with bipartisan support. This law repealed the windfall elimination provision and the government pension offset for certain teachers, police officers, firefighters, and other government workers who did not have Social Security taxes deducted from their paycheck. Under the windfall elimination provision, or WEP for short, anyone who worked in a job that didn't pay into Social Security and who also worked long enough in a Social Security covered job to qualify for retirement benefits had their Social Security benefit reduced by as much as $600 per month. With the repeal of the WEP, this reduction will be removed, retroactive to January 2024. If you were affected by the WEP and had been receiving reduced benefits, your benefit was automatically adjusted to add back in the amount that was taken away. If you have yet to claim your benefit, you can rest assured there will be no reduction for the WEP and no penalty for having worked in a job that didn't pay into Social Security. You'll receive your full benefit the same as anyone else without regard for your pension. Let me make it clear that the WEP affected a very small percentage of people. If you have always had Social Security taxes deducted from your paycheck, it did not affect you. The government pension offset, or the GPO, also affected people who worked in jobs that didn't pay into Social Security, but only their spousal or survivor benefits. A typical example would be a teacher who paid into an alternate retirement system instead of Social Security. If she never paid into Social Security, she would not be entitled to a Social Security benefit. But if she's married to someone who collects a Social Security benefit, she could get a spousal benefit equal to 50% of her husband's benefit. Or if her husband died, she would become entitled to a survivor benefit based on her deceased husband's work record. Under the GPO, her spousal or survivor benefit would have been reduced by 2/3 of her pension amount. This would often wipe out the entire benefit. Okay, that takes care of what's new with Social Security. Now I'd like to offer you a Social Security checkup. In working with clients on Social Security, we found that sometimes people miss out on benefits because they didn't know they could claim them. Here's some examples. Here's a situation that's not terribly uncommon. A married person who never added on her spousal benefit after her husband filed. For example, in doing Social Security checkups, we would look to see if the lower earning spouse's benefit is significantly lower than 50% of the higher earning spouse's benefit. This could suggest that the lower earning spouse filed first and claimed her own small benefit. Then, sometime later, her husband filed for his benefit. This would entitle her to a spousal benefit, which might be added to her own small benefit, but she would have to apply for spousal benefit, which she didn't know to do. Our Social Security checkups reveal things like this. Another one is a divorced person who didn't know she could claim a spousal benefit off her ex-spouse. Now, not everyone can do this because your own benefit must be less than half of your ex's. If you've been working your own if you've been working, your own benefit probably exceeds your divorced spouse's benefit. But it's always good to check. Our Social Security checkups can help divorced people find out if they're receiving all the benefits they're entitled to. Here's another one, a divorced person whose ex-spouse has died. Sometimes ex-spouses don't always keep track of each other, but if a person was married over 10 years to an ex-spouse who has died, she may be able to get a survivor benefit based on that ex-spouse's earning record, which is higher than her own benefit. And these are not limited to women. Social Security is gender neutral. Divorced men can also claim benefits based on an ex-spouse's work record as well. If you or anyone you know would like a Social Security checkup, we may be able to help you identify possible benefits, exploring claiming strategies, and see how Social Security fits into the rest of your retirement income plan. You can call to see me after this workshop or call our office here at Southeast Retirement Plan Center, and we'd be glad to set an appointment for that. So this concludes our Social Security update presentation. We'll be updating this presentation as things change and hopefully presenting that material later. But we do thank you, and I'd like to just let you know that we appreciate you attending. Want to also reiterate every month I mentioned that we have a mailing list that we send good content that is, just as good as this content that's in these webinars. And that's a monthly thing that all of our clients receive. And if you're not receiving that, let us know. We'll be glad to add you to the list. And also, if you refer someone to us, someone that may or may not be ready to work with an advisor now, but may down the road, or they may be looking now, they get added to that list as well. So we'd love to have you add them to our mailing list, and also invite them to these webinars or some of our in-person workshops. And if you do that, you become part of as a client, you become part of our client ambassador program, and you qualify for that program. So feel free to give us a call and let us know that you have a friend or family member that may need to work with a company like ours down the road, and we'll add you to our ambassador program, where we like to have some kind of fun event each year as a thank you for sharing us with others. And that event typically happens in the fall, and it's always a great time. So finally, our next webinar will be on May 12th, and we're going to be talking about IRA planning. So you can see that there's kind of a theme here with Social Security planning and IRA, and how to make the best of those situations. And I think you will enjoy that one as well. So once again, we appreciate your attendance, and feel free, when we get the recording of this out, to direct your friends and family to that. And don't forget to let us know if you need anything or if any of them need anything. Have a great day.